Why does this story keep coming up that China's going to boost inflation again? They've got the opposite problem in China. They're trying to stimulate, and to some extent, their GDP is going to miss even the downwardly revised forecast that they had. I think the thinking is that, hey, if Europe and America need to raise rates, well, then China needs to raise rates as well. But China's really facing, at least according to this fantastic Wall Street Journal piece that came out, which I agree with, because mostly we've been saying a lot of this for the past many months here, that China is actually facing a more likely risk of, quite frankly, deflation. Prices charged by Chinese factories tumbled in May at their steepest annual pace in 7 years, and consumer prices barely moved. The Wall Street Journal suggests that not only is this obviously bad for China's 5% growth target this year, which is compounded by sort of their miss on exports just a few days ago, but ultimately, if they end up getting into this cycle of essentially persistent deflation, you could end up having an economy that falls victim to the downsides of deflation. Remember the downsides of deflation. The downsides of deflation are more psychological than they are practical, because from a practical point of view, we should all want deflation, right? We should want prices to come down. Unfortunately, what happens when prices come down, that is, prices for things that we need to buy, is as a society, we just delay the purchase of those things. For example, if we suspect that the prices of a car are going to keep coming down, then we would eventually expect that, to the extent we can, we would just wait to buy the car. But the problem is, the more companies and businesses wait to invest in either vehicles or assets or whatever, the less money circulates throughout the economy, and then you actually end up with GDP shrinkage, which is really bad. This is why central bankers, along with obviously like monetizing the debt, come on, let's be real, but this is why generally central bankers want to target around a 2% inflation rate. They want some inflation, so that way there's this incentive to continue to invest and innovate and grow. And so what we're seeing in China with these falling prices is obviously good for global inflation. It's an anchor to global inflation, but it also is a sign that China is quite different from the rest of the world in terms of where it is economically. Much of Europe and the United States or Australia or Canada have seen pain from higher interest rates, have seen an adjustment in their real estate market. The United States recovered quite well already because of and thanks to the 30-year mortgage, whereas Canada and Australia and parts of Europe haven't been so lucky in terms of the real estate market. But broadly, many asset markets aren't actually doing that horribly, given kind of what the markets were pricing in last year, which was the depression, Paul Volcker, and a real estate crash, and it already just everything was being priced in last year, whereas today we're not really seeing that sort of pricing in of such pain anymore, hence our Nike swoosh recovery. But this Chinese deflation is not only something to pay attention to for weaker growth on headline GDP for China, something maybe that could end up being a red flag for investments in China, but it contributes to anchoring a global inflation. And then ultimately, it probably puts less pressure on commodity prices. So that's something else to consider. So whether you're investing in Chinese stocks or you're investing in American stocks with exposure to China, or you're betting on commodities because of China, it's worth noting that the present indicators, whether it's producer prices, which are not holding. I mean, look, consider these for example. Okay, consumer prices rose 0.2%, which that report just came out today, and that was slightly higher than the 0.1% we got in April, but China's government isn't targeting 2%. They're actually targeting 3% inflation. And they got an annual gain of 0.2%. That's not a month-over-month number, an annual gain of 0.2%. And the target's 3%. So you basically have no movement in consumer prices. For producer prices, what you have is a negative 4.6% reading year over year. The year-over-year numbers are, well, rip, like non-existent for inflation in China. There literally is no inflation in China. You're quite frankly facing deflation. So consider that when you're looking at either Chinese investments or United States investments that are associated with China. Yesterday, for example, in the course member live stream, we were exploring Nio, and so we did a bit of a fundamental analysis on Nio. Nio was an interesting one because Neo's still in a position of net negative income, which makes valuing it certainly a lot more difficult. But beyond that, they're going to need to raise some money soon. We're convinced that there's a limit to how much money Nio has, and I would expect within the next 18 months, you're going to see Nio somehow raise money, whether that's through a bond offering or through a stock offering. However, they're going to have to raise some money. So we'll see. On top of that, it's worth noting, this morning we realized that the average per quarter gross profit for Nio is usually $186 million. And the average operating expenses in 2022 are usually around $753 million. Well, that operating expense came in roughly in line with the average per quarter expense of 2022 here in Q1. 767 is broadly similar to what we saw in 2022. However, we were looking for about 186 generally for gross profit on average in 2022. That was only $23 million in Q1 2023, which is like no margin. What happened? But that is something to consider when it comes to Nio, and Nio, obviously a Chinese company. It looked to us like, based on our analysis, which remember, if you join any of the programs linked down below, you get lifetime access to not only the archive of live streams, but these fundamental analyses every day the market is open. What we found is Nio would probably have to grow somewhere around 35% compounded annually, or just 35% annually, right? And then that compounds. They would have to grow that for 5 years at 35% just to break even. But their vehicle growth rate in the number of vehicles they're selling isn't growing anywhere near 35%. In May, they delivered 6,155 vehicles. They delivered 43,854 vehicles year to date in 2023, and that represented a 15.8% increase. And the way I got to this 35% annual compounded that they would need is that their operating expenses are sitting at about $3 billion for the year. Maybe you've got some one-time charges in there, so it's worth diving a little bit deeper into that. But if your OPEX is sitting somewhere around $3 billion, which is about double from 2021, much of that operating expense increase being made up of an increase in actually both R&D, which more than doubled, and then SG&A, which probably increased roughly, looking at it here, about 60%. So both of these numbers, it's not like it was just one of them. Both of these increased, actually. But anyway, so when we're looking at Nio, we're like, wow, okay, well, in order to get to just cover $3 billion in operating expenses, and in your last year you had a gross profit of $745 million bucks. These are dollars. You've got some growth ahead of you before you even get to a break even. They do have a gross profit margin, worth noting, is just above 10% on gross profit, but that OPEX really eats a lot of what Nio's doing. But again, something to consider when we're looking at Chinese companies. Where's the money going? What kind of transparency do we have of where the money's going? And in addition to that, now you've got a country that potentially is facing deflation. What is that going to tell the consumer in China? Which is not like it's a carte blanche great thing for every investor, because consider less or more deflation in China could potentially also indicate less buying pressure for GPU chips or Tesla cars or other cars, or other AMD or what should I say, or other companies with large exposure to China, such as AMD. So do consider that there are a lot of companies that have massive exposure to China. Even Apple is another one with large exposure to China. And what you can do is you could go through any of the companies that you're looking at or considering investing in and look at their annual reports. See what percentage of their revenues is coming from China. One stock that I've been interested in, but I haven't pulled the trigger in or on is Starbucks. Partly because during the pandemic, what they did is, I feel like they did this sort of stealthy growth approach to China. While everyone was worried about the Chinese lockdown, Starbucks is like, let's double how many stores we have in China. And so they literally doubled the amount of stores that exist in China, and nobody seems to have noticed. I personally believe eventually people are going to go, oh man, there's a lot of growth coming from China. But then it makes you scratch your head. Will there be if you're in potentially a deflating environment and potentially one where people are now shell-shocked because of what they went through with COVID lockdowns, and one where they're potentially facing deflation? Maybe that's not as a surefire bet. So these are a lot of things to consider when it comes to investing in China, all of the various different companies that are associated with China. And ultimately, I suppose I would just say, proceed with caution with China. I will say, though, just to give you a little bit of a flip-sided argument, there are some people who say, all right, Kevin, everything you said might be true, but now we're at a bottom. Chinese stocks are underperforming, European stocks are underperforming, American stocks. You know what? Now's the time to buy the dip on China. Maybe now is the time to buy the dip on China. I personally can't get away from just investing in America because, again, I feel like I relate to the American consumer. I feel like I could sit down. Let's think about this on just like a person-to-person level for a moment. I feel as though I could sit down with any American, anyone watching. We could sit down, have a coffee, whatever you want to make a drink, whatever it is, who cares, whatever. Point is, we could sit down and actually have a reasonable discussion about anything, right? Really, and that could be an amicable and productive discussion. I don't think I could do that with every single person in China, mostly because I don't understand all of the various different cultures. I'm sure there are people in China who I absolutely could sit down with and have a reasonable, productive discussion, but I don't even know. I don't even know what I don't know about China, right? So I just stay away from markets that I don't understand, and I'm going to stick with the markets that I do understand, and that is my favorite, the best in the world, the United States. So, and I really believe that. Look, I was born in Germany, but I don't even understand all the, cultural things that go on in Germany. Everyone's different. So anyway, long and short of that is it's a lot harder, in my opinion, to really evaluate, okay, are Chinese consumers going to behave like American consumers? And if anything, I actually think they're more likely to behave less like American consumers, where American consumers are more like, if poop hits the fan, we'll get our stimmy checks, we'll get our unemployment. Which the reality is, I think there's a very good chance artificial intelligence will bring back stimulus checks eventually. Some form of like UBI or something to that effect. China doesn't work that way. They offer corporate stimulus as opposed to direct cash payments to individuals. And the savings rates of Chinese are substantially higher than American saving rates, in part because they have to, because the government isn't going to bail them out. Now we could obviously argue about the merits of our government and go down a political rabbit hole, but I'll save you from that in this one. So anyway, that's my take on China. Hopefully that's at least somewhat useful, but I would proceed with caution in China, and if you're still betting on these inflationary arguments from China, look at some of the recent data, because probably missing something. Now, I want you to know this, when it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by